Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm on the line today with an expert when it comes to the market, someone who covers the markets daily, and someone who gives real investment advice. So this is going to be a great show today. My guest is Lance Roberts. His website is realinvestmentadvice.com. You can schedule an appointment with them and they can help you, get real investment advice and analyze your portfolio and really help you in whatever your needs may be at any specific time. Of course, people are young, people are old, people need cash flow, people are looking for growth. I mean, these are the questions that you might have, and he's the guy that I would recommend you get in contact with if you have some of these questions. So Lance, thanks for coming on Crush the Street with me today.
Absolutely. I'm happy to be here. It's interesting, talking about, people with, all different kinds of, time frames, right? Young people, old people, etc. We all do have different time frames and different things. And the things that we do talk about in real investment advice are, the issues that really surround why people don't ever achieve those goals. We just wrote an article recently about the FIRE movement, which is the Financial Independence Retire Early. Sounds great. I'm for any program that encourages young people to save, but there's so many things that it doesn't talk about that potentially become real traps for investors down the road. So, it's important to really kind of understand the good and the bad when you're investing money and making decisions.
Yeah, one thing we were talking about prior to the hitting record here, I mentioned cryptocurrencies, and people are always asking me, how much money should I put in that? Well, it's still very speculative in terms of what it's going to do tomorrow, the next day, next year, and whatnot. And to a certain degree, it's still a new technology. But overall, I tend to be bullish on it. But when it comes to somebody who's 25 years old and has $5,000 to his name that he just started saving 6 months ago,
right,
versus someone who's spent 40 years compounding their wealth and have $1 million to their name, I think their savings, are two different things.
Right.
One could be replaced in a couple months. The other, is a lifetime of wealth that needs to be taken care of. And so it's a very nuanced question when people ask, what should I do with my money? There's so many factors that come into play, and I'm sure you get those type of questions all the time.
Exactly. Well, I think, look, you said something very important here as you're talking about savings, right? Whether you're young or old or whatever it is, where we have lost the meaning of what it means to invest in the financial markets. Beginning in the late 90s, really, when we saw the turn of the markets from an investing machine to basically a Wall Street casino, the problem that became there is that we lost the idea of why we invest. Why do we invest? We invest our savings to grow our savings at the rate of inflation over time to maintain our purchasing power parity in the future. This is about maintaining savings and wealth from the savings. The Wall Street was never meant to be the wealth creator. The wealth creator comes from our job, our business, what we do, how we create capital through capitalism. That's where we build our wealth. We build that through our businesses, and then ultimately we save that money and grow that. And if we continually invest in things that are highly speculative and we spend years getting back to even, that's not growing wealth. That's simply just trying to get back to even. And that's why you have such a problem with the vast majority of Americans so undersaved. They've been depending on markets to bail them out over time. They've taken on too much risk. They've paid the penalty for that. It's important to go back and look at why we invest. We invest to protect our savings and to grow our savings over time. And once you begin to develop that mind frame, the decisions about how, when, and where you invest become much more realistic, and you do better over time.
Yeah, it's an interesting thing when you mentioned Wall Street. I mean, Wall Street has become this place for companies and investors to get, much more for their companies than they would in the private markets. I mean, look at Amazon. Amazon's trading for practically an 83 PE ratio right now, whereas if they tried to sell that company privately, traditionally, you get 3 to 5 times if you're lucky.
Exactly.
But Wall Street has become this, casino to just multiply the valuations of the companies that they're and for who gets that multiple in many situations? Is it the guy that's buying at an 83? Not always, right?
Right. Well, I mean, look, this comes back down to the basic principles of investing. Is that if you overpay for the value of something, look, it doesn't matter, what you think about a company, whether it's Amazon or whether it's Microsoft or whether it's, Procter and Gamble or Coca-Cola, right? A good example, Coca-Cola just reported earnings yesterday. They're very, they had good earnings. But here's a company, Coke. It's a very large, it's a mature company. It grows sales at about 7% a year. They're trading at almost an 8 times price to sales. Now, historically, just to maintain that price to sales level, they have to grow earnings. And this is before they pay taxes, employees, benefits, everything. Out of every dollar of sales that comes in, they have to maintain about a 200% growth rate every year in sales to maintain an 8 times price to sales ratio. They're growing sales at 7% a year. So, when you overpay for an investment, it may work out in the short term. And as long as we're speculatively trading back and forth, it's all going to be fine. But ultimately, when you overpay for an asset, your ultimate long-term valuation is going to be revealed in a much lower long-term rate of return. And it's just simply a function of overpaying for anything. So, we get into these speculative periods in the markets. We're 10 years into this bull market cycle. It is going to end. You are going to have a mean reversion, and we are going to revert valuations back to or beyond their long-term mean. And that's going to suggest a 50 to 60% correction in asset prices. And if you don't understand that's coming, you need to really be careful about how you're investing, because you're going to destroy years of your savings goal and time horizon. That's not being bearish. I'm not trying to be Chicken Little and predict the doom and gloom of the world. That's just the reality of how markets work over time.
Yeah. Well, I want to touch on that a little bit more here. But before we get too far away from Amazon, one thing, and I just want to use this as an example. If you look at the Amazon chart, it's almost as if, Amazon has always been expensive, right?
Right.
Based on what they've done, their earnings, they really don't make much money up until now, right?
Right.
But they've always gone up for the last, since the inception, 2000 or whenever they came out.
Right.
So it's one of these situations where, it's almost irrational. It's always traded above what it fundamentally should be. And this is, a tech, it was innovative, it was something different, and the market treated it as such. And, to a certain degree, it's had to backfill all that valuation, and it's still above, where it arguably should be. But in this situation here, it is what it is, right? I mean, people would have made a killing if they bought Amazon, at any point in time, practically over the last 20 years.
It's true. But that's the thing about this is that's a little bit deceiving. Now, what you said is not wrong. Okay. Apple is also a very good case study about investing and what investors do. And yes, theoretically, if you had bought Amazon or Apple when they first went public, you would have made millions of dollars. Find me one person that did. The reality is that Amazon lost almost 90% of its value in 2001 and 2. It then basically stayed at the price level, around there until 2009. It wasn't until after 2009, really 10, that it broke out, and you've had this fantastic run over the last decade because of this massive liquidity influx into the markets through central banks. We've had this massive migration to automated trading, which is basically chasing momentum. We have the largest deviation in history right now between momentum and value. Now, you're going to get a reversion between momentum and value in the future, and that prefaces this idea of a very large correction in asset prices. But this goes to this same story, is that we get into these ideas that, this is a company that can only go up. And yes, in early years of development, you're paying for R&D and development, you're paying for new innovation, they're gaining market share, they're dramatically increasing sales. You take a look at sales every year, Amazon's doubling or tripling their sales from the previous year. You can do that when you're a small company, and you can justify paying high valuations when you have a strongly growing company in terms of earnings and sales and growth prospects, these companies are now very mature, getting to be very, large companies. The growth rate in Microsoft, the growth rate in Apple, the growth rate in Amazon are going to slow dramatically. And there is going to be a point now, I don't know when, and I can't tell you why, but there is going to be a point that investors come back and they reevaluate what they're paying for those companies. And there will be a reversion in price to align those fundamental values with price. It doesn't seem like that's ever going to happen because central banks are going to bail everything out forever. But central banks cannot control ultimately market cycles or valuations. Warren Buffett once said that the market is a weighing machine, and eventually these assets will be weighed. And I'm not saying these are bad assets. I'm not saying they're bad companies. I'm not saying that you should basically bail out of these assets and go do something else. I'm just saying you have to be aware of what you're paying for these things because ultimately that does correct the price.
Lance, so let's talk about the value in the markets at the moment. Where is the value? Where do you see the opportunity to invest in these markets as of now in 2019? I mean, we're big fans of sound money advocates. We like precious metals. Is this something that you would agree with as a time to be looking at gold and silver? I mean, to be fair, we have seen a pretty significant move in the precious metals here looking at the markets in July of 2019. So do you still see opportunity there now that we've seen it go up some? I mean, what are your thoughts here?
Well, so we have to go back a little bit in history. I've been writing a newsletter now for basically 20 years. In 2013, we wrote in our newsletter that basically we were getting out of precious metals for a whole variety of reasons. And that reason was simply the function that we were seeing this turn in the markets of central banks, liquidity, and what's happening. And of course, that liquidity flush took all the fear out of the market. So that when you pull fear out of the market, gold is a fear-based investment. It's really not about too much about the issue of fundamentals at that point. Gold really doesn't have fundamentals to speak, right? It doesn't have earnings. It's just a what we deem it to be a value. So when we saw this turn of potential liquidity flush in the markets, it's going to extract all the fear out of the markets. And gold is primarily a fear and inflation trade. There was no fear of either one of those. So we got out of gold. We recently added gold probably at the beginning of this year. It was right around January, February that we started adding gold and gold miners back to our portfolios. Why? Because we are now at the end of that cycle. We're at the end of the liquidity cycle. There's a real lack of potential for the federal government, the Fed itself and central banks to continue to stimulate this bull market indefinitely into the future. We are likely to the limits of their ability to manufacture growth in markets. That is the ideal environment to reintroduce fear back into the markets. It's an ideal setup. Potentially to have a reversion in rates because, just this past week, the government passed a new funding bill, which is going to add $320 billion in new spending to our budget. Well, we're already running a $986 billion deficit from 2018. You're now going to add $320 billion to that deficit. Federal revenues are not growing, they're declining. And because of that, we're going to be running $1.5 trillion deficit by the end of 2019. When you're running deficits in a slowing economic growth environment, facing a potential recessionary spat, all those where we are now, that's a very good environment for owning gold. So yeah, we're adding gold to our portfolios. I think that move has just gotten started. And when we see pullbacks in the price of gold, because nothing goes straight up, you're going to get pullbacks. We'll continue to build into that position.
So let's talk about this a little more. We like precious metals, and congrats on getting into it at the right time. I mean, obviously that was very timely to be in precious metals, looking at it this year, as opposed to, holding out for this extended bear market, and even in 2015, when it bottomed, it shot up quickly in 2016. And, since, 2017, 2018, it's felt like another bear market, right?
Exactly.
So looking at it in 2019, I mean, is powerful. If you want to respond to that, actually, that's kind of an interesting topic. Gold has just been one of those things that has just felt like a depressing thing even after 2015 when it bottomed out, because not many people were able to get in at the bottom, and they started getting in the $1,300 range to watch it go back under 1,300 in the $1,200, $1,100 range for a little bit. And then, it shoots back up real quickly. Everyone misses the boat once again. And then, the markets wash and rinse investors.
Well, look, this is, this is part of understanding investing. And, gold, as I said earlier, and look, I always get a lot of flack over this because I say, gold doesn't have a fundamental value. Gold is a precious metal. It doesn't have earnings. It doesn't pay taxes. It doesn't create cash flow. There's no dividend yield off gold. So that's what I mean by fundamentals. You can't compare it to an equity investment because they are not the same thing. It is precious metal. And as such, you have to treat it for what it is. It is a commodity. And commodities are driven by supply and demand. That's what moves the price up and down, right? Are people buying gold or are they selling gold? And if you have more buyers than sellers, it's going to be depressed. It's going to rise up. If you have more sellers than buyers, it'll be depressed. So the problem is for people is that we've now gotten this very short-term investment horizon in terms of our investing. We don't really adhere to a thesis. And if your thesis was to start buying gold around 1,200, what was your thesis? Well, because it's low, that's not a thesis. Your thesis is what drives ultimately gold higher. And if you build the right thesis, then you start building into the position. As our thesis was that we sold gold in 2013 long before the big decline in gold because of what we saw coming. And our thesis was the impact of central bank interventions into the financial markets. The extraction of that liquidity and ultimately the inability of the Federal Reserve and central banks to continue to stimulate economic growth is our thesis now for buying gold into the portfolio. And our position on this gold position is going to be 3 to 5 years. It's not 1 month, it's not 3 months, it's not 5 months, it's 3 to 5 years. Unfortunately, most investors, their time horizon on holding an asset is less than 6 weeks in many cases. The average duration holding time for a mutual fund is now down to 6 months from 6 years ago when it was in 1990. So investors don't invest anymore, they speculate. And there's a massive difference between speculating and investing. And if you're going to speculate, it's completely fine. There's nothing wrong with it. Traders make money. You just have to understand what you're buying, when you're buying it, when you're going to sell it. The problem for most people is they can buy stuff, but they don't understand when to sell it until they've already lost 30 or 40% of their money. Then they sell. And that's typically the time you want to start buying something. So it's important to have the right mindset and the right thesis when you're putting your money to work. Because again, as we said to start this show is that this is your savings. Man, you worked hard for this money. If you're just going to invest without any kind of controls or restrictions, just go outside and light $100 bill on fire because it'll be the same result down the road. And you wouldn't do that. You wouldn't go light your money on fire because that's just stupid. Well, why do you trade that way? If you're going to trade properly. We just put out an article on our website yesterday on Real Investment Advice talking about the rules of poker and how poker applies to trading and the rules to follow when you're investing and when you're trading your portfolio. So have some rules, have a discipline, you'll do fine. Without it, you're going to lose money.
Lance, so let's talk about speculation a little bit. What are your thoughts on cryptocurrency, specifically Bitcoin, in this environment? Do you see it as a potential competitor to, the way we transact and save our money? A potential competitor to gold? Is there a need for it in your opinion? What are your thoughts on it?
Well, a couple of things. First, cryptocurrency is very interesting, right? But it's interesting because the cryptocurrency is the spin-off of the technology that's really the most important thing, which is blockchain. The blockchain technology has the ability to change the way that we transact and do business all across the world. The speed at which we can do business, the security of which we can do business. It'll change the dynamic of how parties interact with each other on business, whether you're selling real estate or buying or selling stocks. It's got fantastic applications, but the interesting thing is there's no real technology out there using blockchain at this moment, right? We don't have a real estate transaction system built on blockchain, but we have lots of cryptocurrency. So, the issue with the cryptocurrency from the standpoint of, is it a value? Is there value in cryptocurrency? I think there's a really neat aspect to what cryptocurrency is and can do. And I own some cryptocurrency. There's about 3% of my portfolio. It's not a huge amount. If it zero tomorrow, it's not going to hurt me. But it's something that I want to be invested in, at least now as it's developing, because I think there's a real opportunity. Is it a replacement for gold? No. The reason is that the volatility of cryptocurrency does not make it a safe haven asset. It's too volatile. It moves too fast in too many directions. And so as a replacement for a barter system, which is, remember why we own gold, right? The theory of gold is if the world goes kaput, we've got a hard asset we can trade with somebody else. We can go get food. We can go get ammo, whatever it is. We can barter with gold for that. If the world goes kaput tomorrow, you can't get to your cryptocurrency, right? Because it's an electronic medium. And if we get attacked by EMP, you better have gold and not cryptocurrency, because you're not going to be able to get to that base. So it's important to understand why we own it. It's a speculative investment right now, and there's nothing wrong with that. I think there's a good potential that over the course of the next few years, you can make a lot of money with cryptocurrency. But as a replacement for gold, it's not. You should have gold in your portfolio. Gold is an end-of-the-world type asset. That's why you own it. It's also not going to be a replacement for a currency anytime soon. And what I mean by that is, and this is something that hasn't got a lot of attention yet, but it will, and you're starting to see it a little bit with this Libra, with the Facebook Libra coin. You're already starting to get some pushback from the government. No government is going to allow another currency to exist that will devalue or deface their primary currency, because currency is how you control an economy. It's how we control trade. U.S. has been manipulating its currency for over 200 years. So does China. So does France. Why do they manipulate their currency? They manipulate currency values in order to stabilize trade between two countries. The dollar never leaves the shore of the U.S. So when we buy stuff from China, those dollars stay in the U.S., and China buys U.S. treasuries to sanitize those trades in order to keep currencies in equilibrium. So if cryptocurrencies ever become a threat to a U.S. dollar hedge money type situation, the government is going to take control of that situation. They are going to ultimately, issue their own crypto. The Federal Reserve will come out with their own version of a cryptocurrency, whatever it is, but it will be the legal tender of the United States. And because they also need to control it, track it, know where it went, and know who owns it and where to get it. So, there's going to be lots of regulatory risk. And this is my point about this, is that this is simply regulatory risk down the road that you need to be aware of. Doesn't mean that cryptocurrency is going to evaporate tomorrow, but it means that there's potential risk to cryptocurrency in terms of value as you go forward. As governments come in, lawmakers and governments will invade this space. It will happen. It's only a function of time, and that will impact, for better or for worse, the value of the cryptocurrency you own. So just be aware of that and make sure that you treat it accordingly. And I think that, like I said earlier, I think there's great opportunity between now and whatever that space is when governments get involved to make a lot of money with it. And I think that's going to be a real potential.
Yeah. Well, especially when you consider how small the space is and the capital that might get injected into it. I mean, we made the case here so many times, right? The investment funds, hedge funds, and, just moving a small amount of money into this space could, it'd be like Niagara Falls going through a garden hose. But it's still early, and I totally understand what you're saying. The regulatory environment, the fight that it's going to be if it does really start to become viable, and I think we're starting to see that happen. So it's not clear as to how things are going to go moving forward. But in conclusion here, as we start to wrap this up, talk to us about, what you see, happening with the markets. What do you see happening with, gold and silver? What are some realistic targets that you see for these investments as we look out in this 3 to 5 year time horizon?
Okay. So let me just talk about how we're positioning client portfolios. Maybe that's an easier way to answer your question, because again, when we build our investment portfolios, we build this around a thesis of what we expect to happen. And that thesis is built on fundamentals. When we write a lot about the risk of markets. And so people assume that we're bearish and we're not invested. That's absolutely not the case. But if, for me to write an article that tells you the 10 reasons why the market's going to go higher over the next, year does you little good as an investor, because we're already invested. So, telling you why the market's going to go up, if it goes up, great, I'm going to make money. What I'm more concerned about is what's going to take my client's net worth away from them. What's going to cause that 30% correction, 40% correction, 50% correction that's going to extract a lot of capital. 2018, people have forgotten that we had a 20% drawdown in 2018. We talked about that in January of 2018, saying, here's the risk. There's a real risk that the bull market that we've been in for the last several years has just ended. And of course, we went sideways for 18 months. We just now recently really kind of broke out above those January highs from 2018 to any significance. So understanding what risk to capital is very important, because making up capital, getting back to even, is not the same thing as making money. So it's very important for us to hedge those risks, and that's what we write about a lot. So let's talk about where we're invested currently. So primarily right now, we have shifted a lot of our fixed income exposure from corporates and from long duration credit to shorter duration, high quality credit. Why? Well, we've had a big rundown in rates, and beginning of 2013, when everybody was talking about rates going higher, we said, no, rates have to come lower. They are going to fall below 2% ultimately, and probably before we're done, we'll be below 1% on the 10-year treasury. That's coming still. So we've shifted, we've brought up our credit quality to a great degree. We've moved a lot of our high yield junk. We've moved a lot of our more questionable kind of corporate credits. There's a big risk in the credit markets because of the amount of debt and leverage that has been brought on, particularly in the terms of what we call leverage loan or covenant light loans. The subprime crisis in 2008 was really culminated around $600 billion worth of subprime mortgages. We currently have $1.6 trillion worth of leverage loans, and about 60% of the triple B rated bonds are on the verge of being downgraded to junk. There is a huge risk to the credit markets in the next recessionary cycle in the market when it comes. That's a big risk to pay attention to, particularly if you own a lot of bonds. That's also why we own gold, and that's why we own other hedges in our portfolios that benefit from both declining rates as well as uncertainty in the market. That's a big case for why we're building in hedges for gold and building in other hedge strategies with our portfolio. We even carry a short position in our portfolio right now, just hedging a little bit of risk here as we're trying to figure out what the Fed's going to do. But then outside of that, how about the equity side of the ledger? The equity side of the ledger is still long right now. We're carrying a higher weighting in cash at the moment than we normally do. We're carrying about 15% cash currently. Again, kind of waiting to see what's going to happen with the Fed. We'll readjust potentially that cash position. But we're now shoring up also the credit quality in our equities as well, making sure that we own value relative to momentum. As I said earlier, we have the biggest deviation between value and momentum ever on record. If the valuation momentum returns to its normal span over the course of what we've seen over the last 100 years or so, that implies about a 30% premium of value over growth. So in other words, in a recessionary environment, particularly coming out of a recessionary environment, value is going to vastly outperform growth-based names and portfolios. So we're starting to already build in that valuation base within our portfolios. And then lastly, of course, as we start talking about this recessionary track, when we get interest rates down below 1% on the 10-year treasury, we will liquidate all of our bonds. We will move primarily into equities. Our portfolios will go from basically 60% stocks, 40% bonds to almost 70% stocks and about 15 to 20% bonds and cash, because of the issue that at that point we will have fully valued prices in fixed income, and the opportunity will then be to start buying the broken pieces of fixed income, looking for broken convertibles, arbitrages, and debt, and then adding on, again, really building out heavily on that valuation side base of the ledger in the equity portfolio, because the real return coming after the next recession will be that recovery in value over growth. So that's kind of our thoughts.
Well, it's powerful. And, just like in the Great Depression, I mean, what are the stats, right? All the millionaires that were created during the Great Depression then, really at any other time in history, when we do have those big corrections, those are the opportunities to make massive amounts of money. Of course, there's only few people that have the money at the time, or are willing to dive in to capture that value, capture the equity at the time, and have the foresight, in the midst of the crisis to, run into the building while the building's burning down, right? So, I hope to have the foresight when this all happens to be in it at the right time. So we've been fortunate to be involved with certain sectors at the right time. And my goal here is to continue to do that as the trends evolve. So having said that, Lance, I appreciate your time here at Crush the Street. If people want to learn more about you, the work you do, in ways that you can help other people, please let them know where they can go and what they can expect to find.
Oh, look, I mean, the best place to go is our website. It's realinvestmentadvice.com. It's basically what we write every day. Both me and my partner we write every day. We put articles out every day talking about everything from economics to financial planning to investing, just on a whole variety of issues. But that's how we do research. So basically, we're just kind of publishing our internal research onto a daily blog site. So, feel free to go by there. It's an absolutely free site. And check out realinvestmentadvice.com. We've got a YouTube channel. We put out YouTubes daily from our radio show. We have a podcast page as well. So there's always new information, new content there that hopefully can help people.
Awesome. Lance Roberts, everyone. Lance, thanks so much for coming on Crush the Street with me today. Appreciate your time.
My pleasure. We'll do it again sometime.